After the early shock of COVID-19, global equity markets have staged a steady comeback since March. And to an extent, this is driven by short-term sentiment. Right now, there's simply more good news than bad. Restrictions have eased and businesses are opening up again. Treatments and vaccines are also being developed. But the economic fundamentals are a little bit more sobering. Some industries have sustained serious damage because demand fell off a cliff. Jobs have been lost, and the post-pandemic transition will endure significant economic and financial consequences, and these may take time to be fully realized. So we are expecting global GDP to contract 4.8% in 2020, but we also anticipate the economy to rebound strongly in 2021. Hence, we are hopeful for an economic recovery, but we're also cautious about the uncertainties right now, including the possibility of subsequent waves of the virus. Investors should be prepared for a hopeful but unsettled journey because of the uncertainty right now. Because we think things will continue to be unsettled over the coming months, we are cautious and tactically neutral on equities. Beyond the next few months, however, we are more optimistic, and long-term investors should consider investing into the downturn. We are overweight equities and corporate bonds in a diversified portfolio, and we would certainly advocate to remain invested. But why remain invested? Well, while not a script for the future, history has shown that post-recession recoveries in financial markets have been powerful. Missing out on even part of a bounce back can be costly, so it's important to stay invested even through turbulent times. The case for overweighting equities and corporate bonds is driven by our belief that we can expect low interest rates to be the norm for some time. And that means cash and government bonds aren't going to yield much in way of returns, making it more challenging for investors to remain exclusively in these instruments, because they simply will struggle to achieve their goals. Yields on investment grade and high yield bonds, well, they're more attractive, and they're also supported by central banks' commitments to purchase these assets. Provided they are chosen well, these bonds should also provide decent levels of income in portfolios. When taking investment decisions, it's important to look beyond the current crisis for opportunities. The pandemic has accentuated consumer demand for digital services such as remote working and content streaming. And as a result, growth stocks, particularly in the technology sector, have surged. Other sectors such as healthcare have also benefited and may emerge as the transition to recovery becomes clearer. We're also optimistic about specific geographic regions. For example, Asian equities and bonds are looking attractive right now, with the region and particularly China arguably better positioned for recovery. There is a lot of uncertainty in the world today, and we believe that we will see periodic bouts of volatility. Geopolitics may come to further prominence over the coming months. For example, ongoing US-China trade tensions, upcoming US elections, and milestones for Brexit may trigger volatility. These are just some of the things that investors need to guard against, and that means diversifying your portfolio by including safe haven investments, and also being realistic about the likely scale of your returns. Please stay safe and have a fruitful investment journey.